Hi and welcome to Swissquote Daily Market Talk. It's Tuesday, May 27th. The European markets kicked off the week on hopes that the accelerated trade talks with the US would lead to a trade deal in the coming days. The US dollar rebounds slightly and the Japanese long-term yields ease from the all-time high levels. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week started on a slow but a hopeful way for the European stock markets, with expectation that Donald Trump's latest 50% tariff threat on the European imports would accelerate the trade negotiations and lead to a kind of a trade deal in the next few days. And that's what the latest headlines suggest. As a result, the STOXX 600 index in Europe rebounded yesterday around 1%. The German DAX index led gains with a 1.68% advance. The French CAC 40 added 1.21%, while the Swiss SMI index also gained on echoes that Switzerland could also ink a deal with the United States in the coming weeks, even though a deal would somehow displease the Swiss farmers. It is said, and Swiss farmers are not to be neglected in Swiss politics, as 16% of parliamentarians in Switzerland across both chambers, which is the National Council and the Council of States, are active farmers, or they have very, very strong ties to agriculture. But that overrepresents farmers in Switzerland, obviously, who make around 2% of the Swiss economy and not more, and around 1% of the GDP, according to a former Swiss ambassador. So the trade negotiations could actually lead to a deal, and the acceleration in the deals with Europe, for example, could help Switzerland to get its own part of the cake, given that the President Karin Keller-Sutter has been actively seeking to talk and negotiate with the US to bring the 30% tariffs on the Swiss imports to at least 10%. Now, regarding that market optimism, I really find it fascinating because the European markets are obviously flirting with all-time high levels today. The US futures were also up at yesterday's trading session, even though the markets were closed. But the reality is that with every piece of information incoming, the collective, the global welfare deteriorates, because today we are in a worse position in terms of trade than we were a month ago, and a month ago we were in a worse position than we were 3 months ago. So the situation is not going toward a better place. The negotiation period, for example, was supposed to last 90 days and it ends all of a sudden, and the tariffs won't be brought below the 10% universal level anyhow, as we saw that with the deal that the United States sealed with the United Kingdom a couple of weeks ago. And at the end of the day, no one can guarantee you that Donald Trump won't wake up one day and simply decide to impose more tariffs on, well, whoever. So that's why I'm very much fascinated by market rallies triggered not by good news, but by the least bad of the options once Trump or his administration softens a previous crazy stance. Oh well, anyway, for now, I believe that fresh trade deals between the US and its major trade partners could actually further boost market sentiment and market appetite and send the indices on both sides of the Atlantic Ocean toward their all-time high levels, toward fresh all-time high levels. But whether that optimism could last is yet to be seen. The economic data, especially the inflation metrics, will be crucial in my opinion. Now, the FX markets and FX rates are crucial as well. To answer a question from yesterday's episode, the FX rates are important for equity valuation because they have a direct impact on companies' costs and revenues. They also reflect the monetary policy in a geography, and or they have an impact on the monetary policy decisions, hence on the borrowing costs. As such, the European Central Bank chief, Madame Christine Lagarde, for example, firmly believes that the turmoil that we see in the US dollar and in the US bond markets today could eventually strengthen the euro's position as a reserve currency, and the latter would increase the sovereign bond demand for the euro area nations. Because keep in mind that the German bonds, for example, that are today considered as a benchmark for the euro area. Sovereign bonds is still rated at a triple A. And the additional demand for the euro area bonds could help lower the borrowing costs in the euro area on top of the European Central Bank's ample support to the economy and help the European companies get a cheaper funding altogether. Then it will be up to the European companies to move and innovate and transform this help into actual euros and growth, and it's up to the European regulators to let them do so, of course. The order book, on the other hand, is actually interesting for short-term traders or investors who are looking to execute their positions in a better way than otherwise, but it doesn't necessarily offer a suitable price predictability for equities, fundamentally speaking. So I hope I could answer your question of yesterday. Now, coming back to the FX markets, the US dollar is better bit this morning, but the greenback remains under the pressure of trade tensions, obviously, and the worsening perception of the US ballooning debt burden, with investors now considering pulling back from the US sovereign markets. And it is, as we talked before in previous episodes, it is a pure confidence issue. The US debt is rising since I'm born, and it's rising exponentially. So it's nothing new. The confidence crisis is. So if investors lose confidence and they pull back, the demand will collapse and the yields would spike. Look, in Japan, a similar crisis is taking place. The 30 and 40-year JGB yields, for example, have recently spiked to the highest levels on record, while the 10-year Japanese yield is at the highest level since 2009 today. So political pushes for tax cuts and spending hikes in Japan are refocusing investor attention on fiscal cracks in Japan as well, at a time when the Bank of Japan is willing to slow its JGB purchases to tighten its monetary policy. And when you think that the Bank of Japan holds almost half of the outstanding 10-year debt, yes, almost half of the outstanding 10-year debt of Japan, the latter could hurt. On the other hand, the higher yields offered by the Japanese JGBs will somehow attract Japanese investors, especially the institutional ones, to the Japanese markets again, and encourage them to partly dump their US Treasury holdings, a thing that could put further pressure on the US debt and further weigh on the US dollar altogether. The dollar yen today has rebounded this morning near the 142 level on the back of a sudden retreat in Japanese yields before a 40-year auction in Japan and a certain rebound in the US dollar as well. But the trend remains in favor of the Japanese yen. And as per the Japanese bonds, well, the liquidity in this market remains quite poor, and I would rather prefer, German bonds, for example, if I want to diversify my portfolio and reduce my US exposure. Now, still in Asia, the latest economic data from China revealed that the Chinese industrial profits rose 1.4% year over year in the first 4 months of this year, up from 0.8% advance in the January to March period, and that's thanks to the policy support from Beijing. On the trade front, there are no fresh news about the US-China trade negotiations. We are still in that truce period. We don't know when it will end though, but there is progress on the China-EU front apparently, as policymakers here are willing to respond and tame the impact of the deterioration of their relations with the United States. So the CSI 300 index is clearing the 50-day moving average support to the downside this morning despite encouraging economic data, while the Hang Seng index is retreating from a May peak. On the individual front, note that BYD dropped almost 15% since last Friday's peak, following reports of steep price cuts in a recent promotional campaign, and the latter raised concerns about margin pressure at BYD. But the move showcases the strength of the demand for BYD, as BYD sales accelerate at an impressive speed around the world, especially in Europe, and price pullbacks in BYD stock price, I think, are quite interesting opportunities to enter or to strengthen the existing positions. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments. your reactions and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.